With the Nifty trading below 24,000, the focus for the upcoming session is whether the index can reclaim that level or if the current decline will continue. Traders are navigating several conflicting indicators ahead of the June 30th expiry. Making sense of the trend requires moving past opinions to look at objective market data. Looking at Monday's performance, the Nifty 50 settled at 23,946. Selling pressure in the auto and IT sectors drove the decline, which was only partially offset by gains in pharma and metals. The Bank Nifty also struggled, dropping 0.77% to finish at 57,727. During the afternoon, the index notably broke below the 58,000 support level. While these index closures appear bearish on the surface, institutional buying activity is currently providing a floor for the broader market. This floor is being built by a significant divergence between foreign and domestic institutional trading. On June 29th, FYIS sold 1,350 crore rupees in the cash segment. However, DIIs bought a much larger 2,801 crore rupees. These domestic institutions are effectively absorbing the selling pressure from foreign funds, acting as a buffer that prevents a more aggressive market slide. The global backdrop also supports this stability. Geopolitical concerns in the Middle East have cooled slightly, and flat trading in the US and Asian markets has left domestic equities without any immediate external triggers for volatility. This combination of steady domestic buying and a quiet global environment sets the stage for a highly specific level-based expiry. To understand the expected range for the session, we look at the India VIX, which is currently holding at 13.60. With the VIX remaining in the low teens, the data suggests the market is pricing in a period of consolidation rather than an expansion in volatility. While some longer-term reports suggest an eventual move toward 25,650, the immediate data for the expiry session points to a much narrower trading range. For expiry day positioning, traders typically focus on immediate support levels where buying interest is concentrated and resistance levels where sellers are likely to step in. In low volatility environments, the index is statistically more likely to respect these established technical levels than to break out based on broader narrative predictions. For the Nifty 50, the primary support zones are at 23,900 and 23,750. On the upside, resistance is expected at 24,050 and 24,150. This suggests a neutral to sideways trend where the index likely fluctuates between the 23,900 floor and the 24,050 ceiling. In the banking sector, we are seeing a split. HDFC Bank is showing relative strength, while Kotak Mahindra Bank and the PSU Bank Index continue to weigh on the Bank Nifty. Options open interest data shows heavy concentration at the 58,000 strike, often causing the index to pin near that level during final settlement. For Bank Nifty, support is at 57,500 and 57,200 with immediate resistance at 58,000 and 58,200. The high open interest at 24,000 for Nifty and 58,000 for Bank Nifty effectively frames the range for the upcoming settlement. Based on this data, we can identify three primary scenarios. The first is a neutral outcome. Low volatility leads to sideways trading with the indices settling near the 24,000 and 58,000 strikes. The second is a bearish scenario. If the Nifty breaks and holds below 23,900, it could open the door for a further slide toward the next support at 23,750. In a bullish scenario, the Bank Nifty would need to reclaim 58,000 on high volume. This would likely force call sellers to cover their positions, potentially driving a rally toward 58,200. Professional traders don't prioritize predicting which path will be taken. Instead, they wait for the market to confirm a move past these specific trigger levels. It seems also important to recognize that in a consolidating market, time decay can rapidly reduce the value of out-of-the-money options as the expiry deadline approaches. Managing risk in this environment requires disciplined position sizing, sticking to stop losses, and avoiding the urge to trade aggressively within a narrow range. To summarize, the current trend is one of consolidation, supported by domestic buying and bounded by the 24,000 and 58,000 strike prices. Markets are dynamic and data changes in real time. This analysis is for educational purposes, so ensure you verify current levels before making trading decisions. Successfully managing an expiry day depends on disciplined execution between these defined levels rather than attempting to forecast an exact top or bottom.